So welcome guys. Namaste. Again another session of Trade Talks with Market Star. This time हमारे साथ Prathmesh Godbole हैं, one of my very good friends, a system-based trader. So today he'll talk about how to do trend following using some technical indicators. So over to you, Prathmesh. Carry on.
Okay, so finally, sorry for the delay. We'll start with a quick overview on what trend following is, what we intend to do today. And so technical analysis is usually a very broad definition. It includes all kinds of stuff from support, resistance lines, trend lines, and dozens of indicators and whatnot. So for purposes of today's presentation, it's going to be very basic. It's going to be just trend lines and a single indicator following the bands. So broadly speaking, there's no perfect or ideal indicator. You can use any indicator really, but ultimately what you're trying to do is find a trend, and a trend is kind of move in one direction with small pullbacks in the interim. This could be up, this could be down, or it could be sideways, which is technically not really a trend. So what we are trying to find today is an uptrend typically. And this works a bit differently for a crash or a downtrend because downtrends are much faster than when it goes up. So we'll tweak it a little bit to filter out both the different types of trends. So normally when you take a trade, there's actually three kind of types of analysis you should be doing. The first is the broad market analysis, whether we are in an uptrend or not. And this is usually not done. People just jump to the trades directly, whether some stock has a breakout or not. And that comes later. What you should check, first of all, is whether the market is in an uptrend. Because if you buy something when everything is going up, then you have a much better chance of a trade working out than, if you're buying like in the last 1 month, if you were buying something because it broke out, it's probably not going to go up just because everything else is going down. So that's the most important bit, which is the macro market trend view, where the overall market is going. When it's in a flat or a downtrend, you don't need to exit all your positions, but you can put on something to hedge it. So you can go short futures, or you can buy put options, or there's lots of ways to limit your downside risk. So once you know the market's trend, then the second is where you actually identify specific stocks or whatever subsectors that you would want to trade. Finally, the third is the execution method. Like if you're bullish on, say, Reliance, then you don't have to just buy in cash. You can buy in futures, you can short a put, you can buy a call. There's complex option positions like a call spread and so on. So, that execution method is again different. So you should not be confusing either of these three. Like you can have the same view and execute in different ways and it's still the same trade. So for our session, we are just going to look at the trend. We will not get into the actual execution methods or position sizing. That's all subjective. It varies for people. So let's directly dive into it. So let's actually go back and start with the first bubble in this century, which is the 1998 to 2000 tech bubble. And this started around 1998, early 99, and ended in mid-2000s. So we have a very simple rule. We're going to use the Nifty index on a weekly chart. And we're going to say that if the price is inside the Bollinger bands. So this is, by the way, a 20 period 1 standard deviation Bollinger band. Normally the default setting is 2 standard deviations. We have reduced it to 1. The common way of using Bollinger bands is to use a 2 standard deviation Bollinger band to find when a stock has overextended. Like if it is outside the 2 SD Bollinger on the higher side, then people usually take it as a mean reversion trade. Whereas what we are looking for is a trend. So we are essentially assuming that if it has gone outside the Bollinger band on the upper side, then it will continue to go, in the same direction on the higher side. Consequently, when it comes back inside the Bollinger Band, it's a kind of rough thumb rule that the uptrend is over or it's taking a pause. So our basic rule is we will look for long trades only when it's outside the Bollinger Band, new ones, and we will exit our long trades or hedge them when the index comes back inside the Bollinger Band. So in the first bubble, your entries would be sometime in 98 when it broke out for the first time, and you will get an interim exit or a hedge here in 99. I think this was the LTCM perhaps drop, and then when the bubble burst sometime in mid 2000, the index was way inside the Bollinger Band already. So the entire decline that happened down to 2002, you would not be making any fresh buys. This decline is somewhere around 46%. So the idea is you switch out from your long positions and move to FDs or liquid funds or defensive stocks. I mean, there's lots of ways to play a downtrend, but the idea is you don't want exposure to those high beta stocks or whatever you are expecting to rally the most. This is one small rally that you might have entered following this rule, and that's still all right because nothing is fail-proof. You are going to get some losing trades as a result of it. Assuming you did buy here, you would again exit for a BV2 3% loss, and that's the end of it. The entire drop was almost 40%, and you got out with a 4%. So I consider that pretty useful. After this, we had a couple of small breakouts. Once again, nothing major, maybe 3 or 4% here and there. Where it got you into the trend is 2003, which is around mid-year. And from here, the index went up almost some 50-60% before it corrected. And this was like if you look at the charts of the stocks that went up in this period, the infra stocks or industrial ones, they rallied almost 100, 150%. And that's because the index was in an uptrend. So this is your filter for when you want to take those trades. I mean, the stocks continued to do well even later, but this was where the bulk of the move happened. This drop was as a result of elections, and following this rule, you actually exited somewhere here. So you stayed out for the entire drop. Your drawdown was very minimal. You re-entered in September. Again, you had these small hiccups where you exited and entered at a slightly worse price. But that's the price you pay for avoiding the big drawdowns, basically. And then going to 2008, once again, you exited before the big sell-off. This was the third week of 2008, where the market actually dropped some 20%. I think it hit the circuit and rebounded. So you would not actually be holding your longs, naked longs into it. You would either be hedged already or just exited completely. And it actually kept you out for the entire fall of 2008 because it never even touched the upper Bollinger. You don't have any like entry filter for a buy trade. The where it actually got you in is in March 2009 after the entire carnage was over. Once again, this gave you a very early entry. You stayed in for most of the rally. After that, the market was flat for about 3 years from 2009 to 2012. This is where some subjectivity comes in. You could follow it by the rule book, and once again, it will keep you out from the 2011 decline. This was around 20%. So overall, the idea of this filter is not to make you like 200% a year, but to avoid those big drawdowns in your portfolio. We'll now jump to the 2014 bull market, which started in March. And once again, we got an early filter in March where you're outside the Bollinger Band. If you use a bit of what you call the Dow theory, where you look for higher highs and higher lows, then that was also true in this case. That all the highs were above the previous ones, all the lows were above the previous ones. So this rally was very easy to identify at somewhere around here. Again, the idea is not to be precise. It's okay if you are ahead or behind by a week or a few percent because you're looking for a move that is 30%, 50% on the index. So it doesn't matter whether you are accurate to the dot. 2015 was again a down year. We We exited early on. We never re-entered in the entire down move. Same for demonetization. This was the drop during and after demonetization. We were out of the market, and we were in the entire rally that happened in 2017. This is a special case because this was a budget-driven, event-driven kind of sell-off, and well, charts can show you events that are binary in nature, like something being very good or bad, like elections or budgets. So this is where this would not be applicable. You should either just exit before the event entirely, or just take a call and decide whether to hold through it or not. Finally, we come to the present day, and following our same rule, we would enter here or somewhere in this range, and we would exit here. That's it. We After this, we do not take any long trades. This was 27 Jan, and from here the Nifty has dropped somewhere around almost 30%. So this is for the index note. So you will have individual stocks that will fall much harder than this, and if you own those in your portfolio, then when you see this happening, uh, this is the point where you either buy puts or lighten the position size, something of the sort. Conversely, this is also useful to find shorts because if it's outside the Bollinger Band, then that's where you look for your short trades. Like this is the place, this is the place. These uh, the catch is of course that the drops are very fast. So then uptrend like in 2017 lasts for a year, but the drops last maybe just a few weeks. Like the entire 2018 sell-off in the later part of the year was hardly 6 weeks, and by the time the price goes from the top of the range to the bottom, it's already like most of the drop is already over. This was a special case because the drop began very slowly, and then it picked up pace. So this is not going to be ideal to find short entries, but it will tell you when to get out of your longs or when to put on your hedges. How do you hedge this? Either by the out of the money puts or sell in futures, or like if the beta of your portfolio, let's say you have a bunch of stocks and some are safe, some are very volatile, then you have a weighted average beta based on how much you've allocated to each, and you sell that much amount of Nifty futures if that's something that appeals to you. Apart from an index, you can also use this for stocks. Let's look at a couple of them. Look at ITC, which is very in the news right now. So ITC, uh, in fact, went below its Bollinger Band right somewhere around a year back at 280, and since then it's never been a buy. So even if you like the stock's fundamentals or its long-term growth prospects or whatever, basically if it doesn't fit this criteria, you don't want to buy. Yes Bank is another case. We actually got a short on it somewhere here. In fact, it's except for this small rally in March last year, it's never been in a trend. We have IndusInd Bank. Again, all of these stocks will sometimes give you a small rally, and you have to take those losses. There is no way to avoid them. There is no holy grail. So if you're following it entirely by the rules, you will end up buying these here and exiting it for maybe a 5% loss. But again, this is assuming that you believe in the stock story to begin with, or you think it has long-term prospects. That's when you would use this. You do not want to use this for something like DHFL or stocks where you have a risk of fraud or something where it can just go down 70% in a single day. So this is in a nutshell. The same thing can be done on very long-term charts, which is a monthly charts. Let's look at an example of a multi-bagger that everybody loves. We look at Aisha Motors. So just switch to log charts, and we got an entry somewhere in 2009, and it stayed the entire time outside the Bollinger Band, and that trend got over somewhere here once and then resumed, and so finally in August at 27,000, and from there it's down 50%. So this will again, this is good for the really long-term holdings, or say something like HDFC Bank, which this would keep you in your uptrend for most of the time. Now it's in fact the first time in so many since 2008 that it's actually breached the lower Bollinger Band. So this is not a stock that would show up as a buy at any point. I mean, again, this the trade-off of using long-term charts versus short-term is the same. The shorter term you go, the more noise you get, but you enter the trade early. And if you go really long-term, you get more signal, less noise, but you miss on it. Like if you use weekly charts instead of daily, you are entering like 5 days late. If you use monthly, you are entering 30 days late versus a daily chart. So you will have to do a little bit of calibration based on what works as per your investment thesis or the trading style, the amount of time you have. And finally, so this is a very simple rule. I intentionally did not put together a back-tested list of raw performance on Nifty or so because it's very easy to do. I want people to do it themselves. This is just meant to be a single filter. It's not meant to be a trading strategy on its own. What you should really be doing is combining this with something else, say on a smaller time frame, or a subset of stocks that you will select based on some other criteria. So this, for example, this will tell you when it's a really good time to buy the bubble stocks or whatever is hyped at the moment. Like you had HEG and graphite a few years back. So this works on that as well. You got this uptrend, it was outside the Bollinger Band most of the time, and we had these brief breakdowns. And the third time it broke down, after that, this was your time to exit. There was no time to enter any time after this. And so just to wrap it up, if you're looking to automate this, there's a website, it's my own website. We have a scan here called Bollinger Band Breakout. So you can pick a scan, it's called tradestream.in. You select the scan and you say scan and you'll get all the stocks that are breaking up. So this week it's only one stock, which is Dr. Reddy. And you can look for same thing on daily. So by the way, this is not so useful on daily simply because there's a lot of noise. Like if I look at Cipla, which is one of the stocks that exited the Bollinger Band, you will see a lot of noise. Like it went up here, but it came back. It will enter and exit. Weekly and monthly is where you want to use this. Daily is going to be very choppy. So that's it for me in a nutshell. Amit, do you have any questions? Or
Prathmesh,
yeah,
audible?
yeah, I'm
Prathmesh,
okay.
my only question is, see, we have decided the time frame, that is time frame is weekly and monthly,
Right.
correct?
Yeah.
And our entry rule is when it is above 1 SD.
Yeah.
It's above upper Bollinger. And our
Right.
stop loss will be?
So
If you
again,
can repeat again.
yeah. So let me go back to
Prathmesh, if you can repeat it again, the entry point, the exit point, and the stop loss point.
Yeah, I'll do that.
And how will you trail it? Say, for keeping a Eicher motor for 10 years, very few investors will be able to keep it.
Yeah. Just a second, I'll reload the chart.
Yeah, sure. Take your own sweet time. Say, for example, something like Hindustan Lever.
Yeah.
Continuous uptrend.
Right.
That can be a very fantastic example. Or something like a Yes Bank, which is continuously in a downtrend.
Right.
So, for people who don't understand what 1 SD is, 1 SD is almost around 68% of your price action that happens. So, we are taking 1 SD above middle Bollinger, 1 SD below middle Bollinger.
Okay, so
middle Bollinger is placed at 20 SMA.
Yeah, so I'm just repeating the data. We're using the Bollinger Band with the parameters of 20 periods and 1 standard deviation. Normally, when you add it on any software, the parameters are 20 and 2 standard deviations. So we're changing it to 1. I think trading view as a problem.
आज ही सबको चार्टिंग करनी है.
We'll switch to weekly. Say 3 years. Okay, Amit, what stock were you asking? HUL?
HUL, lever, any trending stock. We need a trending stock, not a sideways stock.
We pick at HUL and we look at the monthly chart for say 8 years or even longer. 8 years fine. So
Fair enough. Fair enough.
HUL,
Saying is fair
so
enough.
your entry point basically is when the price goes above the Bollinger Band. And as I said, this is one of the filters. You can combine this with others. So for example, I can say not just outside the Bollinger, but also a new high above the previous high. So your previous highs are somewhere here. And so I won't enter here immediately, I'll enter here. As for your stop loss, that really depends on you. I typically use the middle SMA as my trailing stop for the good stocks because they tend to be a bit more volatile than usual. So, if it just enters here, I would not sell HUL. I'll continue to hold it. If it closes below the middle SMA, that's where I would exit. Again, this is not a hard and fast rule. For something like HEG, you can't wait for it to break the middle Bollinger Band. That's too late. For that you would want to use weekly, not monthly. Let's go back to 3 years, maybe 5 years. So in this, if you waited for a monthly, your signal will be too late. Like by the time it goes, it's already down from 2,800 to 2,300. So for something that moves very fast, this is subjective. So that's why I said you can't call this. It depends on what you are trading. For HUL, you can use a monthly, but for something like HEG, you have to use weekly because it moves too fast. In this case, we exit that. Like if you want to be aggressive with your exits, you exit as soon as it re-enters the Bollinger Band. This usually works better for the index, not for individual stocks because they are a lot more volatile than the index. So your rule of thumbs, you use a 20 period 1 HD Bollinger Band on weekly for the index, and when the index is outside it on the upper side, you look for buy trades. If it's inside, you do not want to be buying new trades. If it's outside the Bollinger Bands on the lower side, that's where you look for short trades. Second rule is if the index is outside the Bollinger Bands on the higher side and it comes back in, that's where you look for hedging your portfolio or buying puts or whatever. And that's where you want to lighten the positions. And for individual stocks, if it breaks below the middle SMA, that's your exit point. This is actually very simple to test. If you have AmiBroker or something, you can code this in like 5 minutes and test this to see how it performs. Ideally, as I said, you want to use this along with something else that you trade. So if you use an SMA crossover to trade or breakouts, then don't let that go. Combine this with that strategy. That will make it work much better.
Prathmesh, one more thing.
Yeah.
Can we do pyramiding if stock isn't going in our favor?
Absolutely.
How will you pyramid it?
Right. So which stock should we look at?
Any stock of your choice.
I mean, let's follow.
Say for Nestle.
Okay, let's do Nestle. So the first trend was somewhere here, and basically every time it stays in an uptrend or it goes flat and resumes the uptrend, that's where you can add to your positions. So for instance, the most recent rally was the one that ended just now. So we had this is where you would maybe take your first position. It dips and makes a new high, you add to your position here. It makes a small low, makes a new high, that's where you add to your position. So I'm kind of a big fan of the Rakesh Jhunjhunwala kind of price action trading where you buy on the high, not on the pullback, because you want to be trading in the direction of the trend. So you'll always buy a bit expensive, so to say, because you're buying at the high or going to make a new high, but it kind of gives you a sense of security because you know that the trend is established. Naturally, some of them will fail, some of them will end up becoming the high and will be reversed from there. That's just part of it. You have to size your position such that you don't get a severe loss from any one trade.
Fair enough.
This is actually a great pick for pyramiding because all the high lows are higher than the previous lows. Like
high lows are formed.
One giant trend. Like every time it makes a low and it makes a new high, you could add here, you could add here, you could add here, add here. Like maybe this was the only time where you would add and end up exiting early. but all the others are great time to be pyramid. In fact, this is a great strategy that fits in with pyramid. You can add as soon as it breaks out of the value.
So Prathmesh, if I have to see current structure of Nestle, it have changed completely?
Yeah, I'll just switch to.
So for now, if I have to do pyramiding, I need to do pyramiding on the lower side whenever there is a higher, lower high and lower low formed.
Yeah, I mean, if you're looking to short, then you would want to wait for this to break below the lower Bollinger Band. So below 14,400.
14,500 roughly.
Right. So that's where you would maybe add to your short.
Fair enough. So if Prathmesh done?
Yeah, I'm done. If there are questions in the chat.
If there are any questions, raise your hands or post it in the chat.
Yeah,
I'll
please
ask
post it in
Prathmesh.
the chat.
He can read the chat as such. And I'll upload this recording version most probably by the day end, by midnight.
Okay.
As soon as possible. So I don't think anybody have any questions, including Dr. Saab. Okay, Vallabh. There is question by Vallabh. There is by Realme Pro. Prathmesh, if you can unmute them and ask them.
I can't see them.
I can see them. They are just below.
Can you guys please type it in the chat?
Vallabh and Realme 5 Pro. Can you type in the chat? Let me check what they have.
Okay, so Jaisal is asking, when using weekly charts, on which day price do we actually place the order? So basically, if you're looking at a weekly chart, means you're looking at it after the week has ended. So on the close of the Friday. This is subjective. It depends on you. If you have the time and you happen to see the chart and do the analysis before the close of Friday, it's fine. You can just buy it on Friday itself. Or if you don't have so much time, it's okay to buy on Monday's open, because it doesn't matter, right? You're trading on a longer term time frame. You might buy something 2 or 3% higher, or some stock might gap down a bit and you get it 2-3% lower. It will average out. It won't matter.
Next question is by Vipul. How to hedge portfolio?
So as I said, there are several ways to do it. One, the simplest is if you have a portfolio of liquid names from, say, the Nifty, like Nestle, or I don't know if Nestle is actually that liquid in options, but say Reliance or SDFC or so, then it's very easy to buy puts on it. All the options are liquid. You can buy them monthly, and if the sell-off doesn't come after a week or two, you can square them off. It's not going to be free. There will be some time decay, but nothing in the market. There's no free in the market.
Prathmesh, your voice is correcting, guys. Yeah.
Is it audible?
Somebody have asked? Yeah.
Okay. So if you say hedged it in February when we got this signal to exit, when it closed in the Bollinger Band, then that would have paid off very well. Next question is how to act on a consolidating script like Nestle. So Nestle is consolidating now. The idea is you don't want to act on it. That's the whole idea. This is going to tell you which stocks you want to look at for trending. If it's inside the Bollinger Band, just remove it from your watch list. There's nothing to do there. If you're very good, you have experience in doing option writing and all, maybe you can do short straddles or something, because if it's in consolidating, then it's probably not going to go out in any one direction substantial. In fact, even if you're doing short straddles or so, this can be a stop loss for it. Like if it exits the Bollinger Band, that's probably a trend. So that's a point where you exit your straddles. Next is we go short once candle has closed outside the lower band and exit once. So it's this is not for shorting. In fact, short is something that is very subjective. As I said, the shorts are hard with this because the markets sell off much faster than they go up. So if you use a weekly chart and you short after 5 days, the drop might be over already. What this is more useful for is to tell you when to buy and when not to buy, which is more important, because this will keep you out of the most of the big sell-offs. Can we use this for futures? Yes, you can use this for anything that you can plot a chart for. Yes, there is a backtest, but as I said, I did not share it intentionally because It's very subjective. It depends. I might exit as soon as it enters the Bollinger Band. You might exit at the middle Bollinger Band. It's very simple to code. If you have Ami Broker or something, you can code it in 5 minutes and test it. Then broad market analysis and entry should be taken in the same time frame. Yeah, ideally, because otherwise it won't really make sense. Because if you're saying that Nifty is bullish on a weekly but it's bearish on a monthly, then why would you want to buy? Or some stock might be. I mean, whatever on a higher time frame, you should always get more importance than something on a lower time frame. Which is more accurate, MA crossover or DB? Well, that's for maybe you to backtest and check. MA crossover is not ideally for it's not going to be as useful simply because if you use a 10-20 MA or something, your signal comes 10 weeks later. That's really late. It's not very useful.
They are lagging indicators as such.
Yeah. So Bollinger is also lagging in a sense that it's using the average of the past 20, but
it's also using standard deviation, so it gives the result much faster than anything else.
Right. I have a couple of questions on the private message.
ITC changing its trend? No. Mahakal, I'll on behalf of Prathmesh, I'd like to tell, trend doesn't changes in a single day. Okay, if the trend is down, it will take at least 6, 12 or 18 months first to settle down on a price basis. Then there will be a time correction. Post a price and time correction, trend might change. So don't look for smaller bounces as trend change. They are not trend changing.
Right. So I have one more question. It says, can we use it for trading on a smaller time frame? Yes, you can. As I said, the problem is always that the smaller the time frame you go, the more is the noise and the less is the signal. So if you're planning to use it for intraday, you test it. That's all I can say, because it might work on something, it may not work on something. This is like an idea for you guys to work on. Just write an AFL, see how it performs. For longs taken when stock moves above the upper band, the 20 SMA should be taken as a stop loss. Yeah, that's one way to trade. As I said, that's one of the simplest ways to trade this. The second is it won't be a fixed level, but whenever it closes inside the Bollinger Band again, that's where you exit. We don't know what that price will be. Can we identify news impact earlier on price action for future reference? I'm sure. I mean, nobody knows, right? Who knows whether the news impact is being reflected or not, except the insiders who know it and who have the capability to put large positions on. I don't know.
Fair enough. So I think, Prathmesh, we are done almost.
Yeah, I guess.
So if there are any further questions, you can contact Prathmesh at his Twitter handle.
Yeah, I post my Twitter handle here in the chat. So
sure.
In case anybody has questions, you can DM or tag. So
okay. So thanks everybody.
One last question here, I think.
Yeah.
Almost all the stocks are 30-40% below the top. Yeah, I mean, this is not a market where you want to rush in and buy, because nothing is outside the Bollinger Band probably, except the one stock we saw, which is Dr. Reddy. So apart from that, there's nothing. Probably most stocks are not even inside the bands; they are probably outside the lower bands. So yeah, if you're looking to buy, then definitely you want to wait and see how it plays out. Okay, Amit, I'm done.
Okay, Prathmesh, very thanks. Guys, I'll upload this video most probably by the day end. Thanks everybody for joining, and thanks for showing patience, because there was some problem in that free conference call software. I don't know what errors coming. So thanks everybody. Thanks Prathmesh. Let's catch up again soon.
Thanks, Amit, for hosting.
Bye.